Welcome, everyone, and thank you for attending today's webinar. I'm David Shaw, the Publishing Director of Family Business Magazine. I hope that you and your families are all in good health and have great plans for this summer. So here we are, nearly post-pandemic and probably pre-recession, who knows, with inflation rising to new highs. High inflation can act as a tax and slow growth all by itself, but it also increases the risks of a policy misstep where overly aggressive tightening by the Fed could trigger a recession. So what's a family business to do? That's the subject of today's webinar, and I think you will find it fascinating. So before we get started, we welcome your questions and especially your thoughts and comments during the session, as always. Use the Ask a Question button down below where you see the slide, and we'll get to as many of them as we can today. We'll go for no more than 60 minutes, and get to as I said, as many of your questions as possible. We will also forward a copy of these slides to everyone afterwards so you can refer to them at your leisure. There will be a recording of this session available as well. So to help us think through these implications of inflation and what might happen with the economic outlook, I'm pleased to be joined by the Chief Investment Officer of Whittier Trust, Sandip Bhagat. He is responsible for Whittier Trust's investment policies, strategies, and research across traditional and alternative asset classes. Sandip has over 25 years of portfolio management, research, and trading experience in equities, asset allocation, alternatives, derivatives, and multi-class investment solutions. Thank you for joining us, Sandip. It's really an honor to have you with us, and I can't imagine anybody better qualified to talk about some of these thorny issues. How did we get from being in a really strong economy to the verge of a potential recession all in the space of a few short months?
David, first of all, I am delighted to be here. I welcome the opportunity to have a conversation with you and connect with your audience. And yes, indeed, my goodness, we live in such interesting times. And yes, also, what a difference a mere 6 months can make. So let's first contrast the market turmoil of 2022 to what right now seems like almost a utopian mix from last year. You had stimulative policy, low volatility, high returns, and the world this year is quite different. So what changed? The success of the US economy and the stock market last year was driven by solid fundamentals. They were specifically an unusually strong US consumer, an unusually massive stimulus in the form of low interest rates, and fiscal stimulus, which is spending by the government to help us get over the divide or the valley that the pandemic left us with. Mm-hmm. And right there, as good as it was for last year's economy, it turned it into a red-hot economy, which got simply overheated. So what happened during the pandemic? You had global lockdowns. There was a clampdown on mobility and activity. Incomes remained the same because of the stimulus. There was no outlet for spending, so pent-up demand was building up. At the same time, where the pandemic created supply chain disruptions. So this was a toxic mix of excessive demand and limited supply, which got inflation going. And what we have around us right now is persistently high inflation that has forced the Fed to become more hawkish. They began the year by saying they would stop tapering, they would hike interest rates, they would reduce their balance sheet, and by golly, they have done that. The Fed funds rate is now up to 1.5% from 0, and they have already started to reduce their balance sheet. Now, what has gone on at the same time? Interest rates have gone up, and this combination of stubbornly persistent inflation and higher interest rates has now raised the specter of a recession. And along the way, back in February and March, we were delivered a couple of other setbacks We had the war in Ukraine and lockdowns in China. And what they did was they conspired to make the supply chain issues even more problematic. And so this has already taken a toll. Stock prices have declined in response to rising interest rates. Bonds, of course, fall in value when interest rates go up. So as of last week, stocks were down 22%, bonds were down 12%. And that leaves us with unusual volatility. And I thought, David, we could frame today's conversation to answer the following types of questions, right? So what has the impact of inflation been so far? We know it has resulted in high food and energy costs. Mortgage rates have gone up along with interest rates. Home prices are still high, therefore affordability is low. Will this trigger a housing crisis? I think our audience may be interested in these issues more at the family or the personal level. Then, of course, there is the economic outlook. How much has the Fed done in terms of tightening? How much more is left? Will there be a policy mistake along the way? Will this high inflation spell the demise of this economic cycle? When will it trigger a recession? How protracted will the bear market be? What would cause inflation to subside and for the bear market to end? These are all relevant questions. We'll try and address those. And finally, I know our audience has family businesses, intergenerational at that. How does inflation affect your business and what perhaps could be done on that front as well?
Excellent. So how high is inflation really, and how widespread are price increases and so on? I mean, we know it's high, but okay, here we go.
Look, inflation is remarkably high and it is remarkably pervasive. On this chart, think of the breadth of inflation in the context of, exactly where inflation stands across the globe. We will look at different regions. What we show on this slide is just how much above target levels is inflation running in different parts of the world. So these blue bars that you see, starting with the United States, it's not the level of inflation, it's the level in excess of target. So let's look at a specific example. We know headline consumer price inflation is running at 8.6% as of the month of May. The Fed's target for inflation is 2%. And so the excess above the target shown on this chart is just about 6.5%. And the idea here is if you look at this, you look at Germany, the rest of Europe, you find a similar problem. Inflation is well and truly entrenched. And speaking of the breadth of inflation, I thought another useful way to look at it would be to look at the components of what makes up consumer price inflation and see if there are any dominant categories or is everything, are prices for everything going up. So we show here components of headline CPI inflation. It's a really busy slide. What I want to highlight, there are two categories that jumped out at me when I keep looking at this and thinking about this. They are conveniently bookended on either side. So let's start at the far left. And the biggest chunk of the first bar is in lime green, and that's the price of cars, new cars, used cars, vehicle parts. So those shot up in the very early days of the pandemic. We're going just about a year back, so that information is from June of 2021. It's curious that while car prices were going up, energy prices were kind of holding flat, and the exact opposite is happening at the far right. Look for the tallest bar at the right, and you will see that the green component of that bar is now in negative territory. Car prices are starting to actually come down. And the dominant contributor to inflation is in that navy blue bar, which are energy costs. And so just these two categories, energy and vehicle prices, have accounted for almost half of CPI inflation over the past 12 months. And David, the point I would like to make for the audience is that, look, car prices shot up because there was a shortage of semiconductor chips related to the supply chain disruptions. We know that energy prices are related to the war in Russia. The war that Russia is fighting in Ukraine. The war will end at some point. The world will be restored. Supply chains will reopen. And so the energy markets and the car markets will return to some sense of normalcy. And when that happens, a lot of these inflationary pressures will dissipate and abate and get squeezed out.
Okay. Well, you mentioned the war, and I see that big spike in inflation in March, and I assume that's related to the invasion of Ukraine?
Yes, so Russia invaded Ukraine on the 24th of February, and from that point on, we saw it unleashed a spike in inflation, really all related to commodities. So let's take a look at exactly why this happened. And again, what may lie ahead. So just step back for a moment. Russia and Ukraine, in terms of their composition in the global economy, they're a small part. Together, they make up less than 3% of the world's economy. Yet, that event, that geopolitical outcome in that part of the world has had an outsized impact for one simple reason. Both Russia and Ukraine are large producers and then exporters of commodities. So this focuses just on Russia. As far as Ukraine and its commodity centric economy is concerned, just think of Ukraine as the bread basket for Europe. So that's where a lot of the grain and those commodities come from. But just focusing on Russia alone, they're producers of 43% of the world's palladium, 16.6% of natural gas, 12% of oil, and all of these immediately got affected. So the big spikes that you see in the middle there, guess what? That's from the end of February and the beginning of March. Those have since abated because the longer the war goes on, the scope of Russia's involvement in Ukraine has kind of come down. It's not all out across the country. They're now focusing on the eastern part of the country. Nonetheless, these pressures have abated, but this put severe pressure on food and energy prices globally. So if the next concern is, because of these developments, if food and energy prices might impinge on consumer spending, and we know the consumer is a big part of the US economy. So if consumer spending gets affected by food and energy prices, could this alone exacerbate the slowdown in the US economy, one that was already being affected by pandemic-related inflation outcomes and the subsequent rise in interest rates? I thought it would be interesting, David, to just take that question head on. It does affect, our families, everybody who was on the call. And I thought this next chart might surprise a few people. So here we go. This isolates food and energy and shows how big a component they are within consumer spending. The blue line here shows energy costs as a percentage of total consumer spending, and the gray line shows food and energy combined. And as far as gas prices go, and we know we have had the sticker shock at the gas pumps, the good news, if there is any good news to an outcome like this, is that energy costs make up 4% of total consumer spending. And in terms of some historical context, this is well below half of the levels that those costs represented back in the 1980s, for example, right when we had that oil shock and the big spike in oil prices. Food and energy together make up 12% of total consumer spending. And again, this is well below half of the levels that were seen in the 1960s. David, I'm just reminded that instead of just focusing on some positive out of these relatively small metrics, I would be remiss in not observing, pointing out, and then commiserating that sadly and unfortunately, food and energy make up a big component of spending for lower income households. And they have been unfairly singled out. This has been more punitive on those. And that is a cause for concern and for sympathy as well. And so I just wanted to put into context the impact of the war in Ukraine. We know it exerted pressure on food and energy prices, but the impact on consumer spending may be less than what many in the audience may have feared.
Interesting. Yeah, this is a really fascinating chart because it also shows some of the differing nature of the percent of spending, right, in the United States. And I certainly see that spike in the 79-80 region. I remember living through that, and it seemed like the end of the world. And then now, with inflation being what it is, it's nowhere near that level, right, of spending.
Yeah, well, I'll make a couple of comparisons to the 70s along the way. And let me preview that. I have some kind of good news to share on that front. I don't think we're going to get mired in a long, protracted period of stagflation like we did back then.
Okay. There was one quick question that came from the audience that's related to what you'd showed with Russia's spending. Do you see the lack of supply from Ukraine, with wheat and potash and all of that, having a disproportionate impact on the world food supply?
It will clearly have an impact. I want to highlight one outcome, which has kind of pushed back the recovery of global supply chains. Don't expect this to get resolved in the near future or anytime soon. This will play out. The war has lasted longer than what many had expected. It is now more than 3 months old. Its impact is truly pervasive. This is absolutely global in nature. And you really have to feel for emerging market economies, the poorer countries where food costs more as a percentage of income and total spending. And that impact is real. It will last. It's not disappearing in a matter of a few months.
Just a question that came up with you looking at the components of the CPI. Did any of the sort of the stimulus that went on during the pandemic, has that contributed to inflation as well, or is that not a factor?
David, I hesitate with my pause because I want to make sure I give you a response that is grounded on economic considerations. I know this can very quickly become politically charged about, policies undertaken by a specific administration. But if one must look back to see if there were contributing effects or factors to where we find ourselves, yes, I'm afraid we probably overstimulated, and the Fed, by the same token, waited way too long before starting to raise interest rates. And that fueled the demand side of the equation, which got magnified because supply had not recovered. Right. And Russia and China, or events triggered by Russia and China, pushed back the recovery of supply chains, and the Fed's delay in acting, and then a couple of extra doses of fiscal stimulus. We did 5.8 trillion. We perhaps need not have done the last one or 1.5 or 2 rounds. But that's all easy. I know I'm playing Monday morning quarterback. We had not had a global pandemic in 100 years. Nobody had visibility, or clarity while we were living through it. And it probably made sense to err on the side of being extra careful so that we didn't go into a depression. But in hindsight, yes, we overstimulated.
Interesting. Thank you. So let's talk about high inflation. Why is it a problem? I mean, we know it has an impact on prices, but what's your overall outlook also for inflation?
Stephen, if it's okay, I'm going to turn the sequence of your question around. Let me
Sure.
give you the outlook first, and then I want to latch on to one of the most insidious and devastating effects of continued high inflation. But in terms of an outlook, let's look at this trend of how inflation has been evolving on a monthly basis. This just a single bar. What are we showing here? On a monthly basis, we're showing the change in core CPI. The word core simply means that from the headline number, remember I said that inflation was 8.6%? That was across all categories. If you strip out food and energy, that gives you core inflation. What has been the month-over-month change in core inflation through the pandemic? And what would I point out here? I would say the following, that if you look at all the bars to the right, they are not nearly as high as they were a year ago. There are 3 really tall bars. I think if I squint at my screen, there would be April, May, and June of last year. So yeah, inflation is not increasing on a monthly basis as rapidly as was the case a year ago. So that suggests, so the idea here is to look for clues that suggest that we might be approaching a peak or at least a plateau. This looks suspiciously like a plateau. Over the last 7-8 months, we have kind of flattened out at about 0.6% of monthly increases. But the bigger question is, what lies ahead? And a few things come to mind. We have already seen inflation. Remember, we talked about car prices and gasoline and energy costs. Well, gas futures have declined literally in the last week or 2. There is greater talk of a recession. That, of course, suggests a decline in demand. And with that, oil prices have come down. They were at 120 for US crude not too long ago. They were 105 when I last checked. Used car prices have rolled on. Freight rates have come down. There is every indication that in the coming months, inflation will gradually roll off. And the one last observation I would make here, actually, I'll make 2. Let's talk about wage inflation. That's a key driver because U.S. economy is 70% driven by the consumer. And as goes the labor market, so goes the U.S. consumer. And the labor market goes based on what happens with wages. Wage increases, hourly earnings, average hourly earnings have been rising at about 5.2% on a year-over-year basis. But if you isolate the last 3, 4, or 5 months, the annualized rate of the increases in recent months is more like 4%. So that seems to be tapering off. And the one kind of big argument I would offer to our listeners is this is the most basic tenet of monetary policy and economic fundamentals. Friedman said that inflation is always and everywhere a monetary problem. What happened last year from the types of stimulus that you were talking about, David, money supply, the amount of money circulating and sloshing in the US economy shot up. It was up 30, 40, maybe 50% at given points of time. that works on a lagged basis. So we're seeing the effect of that increase in money through the inflation spike that we are experiencing right now. But that money supply, because the Fed has started to raise rates and there is no more fiscal stimulus, the government is not sending out any more checks. Money supply has declined to a mere 5 or 6%. It'll go to zero, whose effect will be felt in the coming 6 or 12 months. Just like last year's spike led to an increase in inflation, the decline in money supply, we believe, will allow inflation to taper off as well. So I promised you an answer on why is this important, and you actually highlighted that at the beginning of your conversation. At the most basic level, inflation acts as a tax, right? You're spending more on goods, you have less to spend elsewhere. That alone can bring growth down. And in addition, as central banks, so the Federal Reserve Board here in the US, as they start to grapple with inflation, when they raise rates, there is always a risk that they don't do enough to conquer inflation, or they do too much and really stifle and suffocate and choke off the economy. So it introduces that risk. But there is another more powerful, maybe less obvious, and a nuanced concept that economists call the wage price spiral. Let me explain quickly what that means. This is how it sets in. Prices go up, workers find that they cannot maintain their standard of living. They cannot buy all the goods that they were doing previously with the amount of income or wages that they have. And so they first meekly and then more aggressively go to their employers, they go to their bosses. David, I'm giving you an idea of what you might be able to do. And say, okay, it's time for a pay increase. My wages need to go up. And I'm not being greedy. I'm asking for that so that I can just keep pace with the cost of living.
Right.
So they get a wage increase. The minute they get a wage increase, they now have more dollars to spend than they did a week ago. So, of course, they go out and spend it, which pushes prices higher because there are more purchases than was possible without the wage increase. So now you have even higher prices, which means that this amount of wage is not enough for the new level of prices. So they go back, ask for more wages, get more wages, that pushes up prices higher. And so this is absolutely dangerous because at some point, this spiral, when people begin to expect it, if I have a fear that prices are going to go up 6 months from now, I'm more tempted to go out and buy that same good today, right now, before the price increase 6 months from now. But the very fact that I ventured out and I spent the money today pushes the price even higher now. And so it is paramount that this inflation episode doesn't get embedded or anchored in inflation expectations for the future. Kind of begins to move to our next topic, which is we're going to talk about the Fed. And the Fed is acting aggressively after being late. They're acting aggressively just to manage those inflation expectations. They really need to keep those tame and squished down, because the minute inflation expectations go high, when people negotiate contracts like for new financing or for wages or for rents, you will spiral this out of control because those expectations will get embedded into these long-term contracts. Let me give you a bit of positive news. I promised to make a comparison with the 70s. This wage price spiral, may not unfold with the same ferocity and velocity that it did back then. For one important reason, back then, union membership in the private sector was about 25%. Today, it is 6%. This simply means that labor, while it does have more negotiating power today, right now, than they have had any time in the last 10 years, it's still not as powerful or impactful or forceful as it was back in the 70s. And you have this inexorable force from technology, which is related to artificial intelligence and robotics and machine learning and automation. It has gone away for right now because we have labor shortages. It's going to come back in full force. And I do see these pressures being pushed lower.
Interesting. Well, thank you for making that observation. Let's talk about the Fed. First, why do you think they waited so long? Did they make a mistake in waiting to adjust policy?
Again, with the full benefit of hindsight, the Monday morning quarterback in me says yes. And by the way, there is universal both acknowledgement and condemnation of their actions. The Fed for a very long time has chosen to err on the side of being more accommodative. So, they have a dual mandate to keep price stability and full employment. And they've just focused on the economy and the labor market and full employment at the risk of inflation. So they've been more dovish to keep the economy going than becoming hawkish in response to inflationary pressures and risking a recession. But the misguided belief that inflation was fleeting and transitory leaves them so far behind that right now they have this really uncomfortable choice, which is really get on top of inflation right now, keep raising interest rates and do everything they possibly can to fight it off. But this would risk a recession, or avoid a recession, in which case inflation will keep lingering. And the longer it stays at these high levels, the more likely it gets into expectations. And then you have a really difficult stagflationary period of high inflation and slower growth. And you don't want a repeat of this lasting for 3, 5, 7 years. Right. You'd rather take your dose with a short, shallow recession soon enough, get this behind us and move on, than worry about this for 5 years. Right. So yes, I'm afraid they did make a mistake. But let me give them credit. Again, it was through a pandemic that had not happened in 100 years. And so it's very easy right now to point that out. But I also want to talk about something that they did right. You might think that in the context of being late, they're hopelessly and woefully late. Why? Because the Fed funds rate is 1.5%. And inflation, remember I talked about the CPI inflation, that's at 8.5%. How can you conquer 8.5% inflation when your interest rates, your short-term interest rates are at 1.5%? So this might lead you to conclude that, by golly, not only were they late, they're like ridiculously late. And I want to dispute that or offer a counter perspective. What the Fed has done right, to its credit, which has had an effect, which means that we are not so far behind, is they used a technique called forward guidance. They gave really clear communication of what they were going to do. Right? And so because of this, the minute they articulated that the next July meeting would see 50 or 75 basis points of more interest rate increases, and there would be an interest rate hike literally for the next 6 months, that has caused the dollar to go up. It's up 10%. Interest rates have already gone up. And as I mentioned, stocks have gone down dramatically. They're down more than 20%. So a strong dollar, higher interest rates, and lower stock prices lead to what the economists would say is a tightening of financial conditions. Things around you are not that easy. You've lost wealth. Your financing costs have gone up. Things are tighter or more difficult. So this combination of tighter financial conditions already has had the effect of 3 or 4 rate hikes. The fact that they're going to reduce their balance sheet by $500 million in the rest of the year is the equivalent of another rate hike. So think of the Fed funds rate not at 1.5. The world and the economy is operating as if the Fed funds rate was at 3%. And so I just wanted to call that out. Yes, they were late, not hopelessly late.
Yeah, and there is a perspective issue here as well. I clearly remember my first home purchase was at 10.75% interest rate. It's different now. We're expecting lower rates. Question came in though. Yeah, they've acknowledged, the Fed has acknowledged that its economic forecasting models didn't work, and they're analyzing why. But what was behind them being late to the party, in your opinion?
Look, they had a choice to make.
Yeah.
No one knew. And by the way, look, I wasn't around in the last pandemic in 1917, and I think we have too many people alive on this planet who lived through it as an adult, for sure. And if you look at the history books, the global shutdowns that we imposed back in March of 2020, entire swaths of the economy, entire sectors shut down overnight. Businesses there was no contingency plan to pull out. But what happens if my revenues decline by 20 or 30%? Revenues fell by 100%, right? And we didn't know what the long-term effect of such a hit to the economy would be had we not acted in time with the first round of stimulus. So what the Fed did in April and May with increasing their balance sheet, what the central government did with the first stimulus package of 3.9 trillion, absent that, we could have experienced a Great Depression. Mm-hmm. We would have done so much damage to the economy in the near term that it would simply never have recovered. So the Fed just had no idea what kind of damage would be done. And so conservatively, through the recovery in the pandemic, they just chose to focus on the health of the labor market and the economic recovery. And they said, we will take our chances with inflation. And so it was a judgment call, in hindsight, ill-advised and misguided. So your question now is, well, there's at 1.5%, but what lies ahead? What are they likely to do, right? And so this is a super busy chart, and I'm going to speed up my responses. David, I don't know how we're doing on time, but
we have about 22 minutes.
Okay, so just think of the navy blue bars. These are the Fed's forecasts for where it expects the Fed funds rates to be at the end of each of the 3 calendar years. 2022 is 3.4%, next year 3.8%, and in 2024 at 3.4%. The teal bars are at slightly lower levels. That's the market's expectations. The market is now beginning to think that the Fed, through its last communication after the June meeting, is overly hawkish, and that an impending recession may cause them to rethink. But I want to put this in context as well. Even if they take rates to 3.5% or 4%, inflation is running so much higher. Headline inflation is 8.5%. If you look at other core metrics, they are measured at 5 or 6%. And so the skeptic would say, listen, this is not going to get the job done, because economic theory says Fed funds rates need to climb up above inflation for it to push inflation down. This would be a fine, valid argument if today's inflation was only demand driven. I am going to suggest that it is both a question of demand and supply chain issues. So in other words, the assault on inflation and its eventual vanquishment or pushing it lower is going to come from 2 entities. The Fed will need to do its part to bring demand down, but it will need help from the private sector. And again, I want to offer some hope. I don't think the Fed will do anything as draconian as take the Fed funds rate up to 6%, which is what theory would say needs to happen for inflation to come down. They won't need to, because the private sector, through its continued efforts to open up the global supply chains, will contribute with increased supply in bringing inflation down as well. And I need point only to China. Yes, they had those severe lockdowns, but they were mainly at the end of the first quarter through the middle of the second quarter, but they're now beginning to reopen. And China's recovery, its reopening of the economy will ease not only supply chain issues, but from the damage that their economy suffered through those lockdowns, they're now stimulating. They're cutting interest rates, they're increasing fiscal spending, and a recovering China will help global demand. And Europe, which is the most vulnerable because of the food and the energy shock, this bodes well for them because Europe's biggest trading partner is China. It's not even the US. So again, as China goes, so will Europe.
Okay. Well, I referred to my first home purchase many, many years ago with the higher interest rates, and remember when those interest rates were much higher in the late 70s, early 80s. With these higher interest rates, I think there's a concern. We've had a hot and maybe even superheated housing market. Are we going to see a crisis similar to what we saw in 2008?
Look, what is giving rise to these concerns? We know mortgage rates have gone up. Home prices are beginning to decline, but at a really gradual pace. So this combination of still high home prices and rising mortgage rates really brings down affordability. It's at a record low in 44 states in the United States. And it is this graph that leads to that concern. On the left, we show mortgage rates, and we can't draw these charts fast enough. It shows here mortgage rates at just above 5%. They're actually now up to 6% or close to 6%. They were at a mere 3% not too long ago. So that's the chart on the left. On the right, when you combine higher mortgage rates and still high home prices, the blue line on the right chart shows what is the cost of servicing your mortgage debt. And that cost has gone up dramatically as well. So this is the genesis for the question that you ask. And if you are tempted or concerned about a parallel with the housing crash that accompanied or that led to the global financial crisis, let me share a bit of good news. We are nowhere close to that outcome. And it is for these following reasons. I managed to squeeze in 4 charts on one page. Let me tackle each of them in rapid fire fashion. I'm going to begin at the top left. The top left shows what kind of home inventory exists. Have the home prices been speculative in their escalation, or were they driven fundamentally by supply-demand issues? And at the far right of the top left chart, you see that home inventory these days is so low. It is only about 2%, it's only 2 months of supply. And contrast this to 2006 and 7 and 8, where you had more than 10 months of supply on the market, and yet prices were going on. I'm going to suggest that was speculative. This is the influence, it's the result of low supply and high demand. So more fundamentally based, not speculative in nature. The next chart is the top right chart, and it shows that adjustable rate mortgages are a much smaller percentage in this go around. Most ARMs are also have a fixed rate locked in for 5, 7, or 10 years before they begin to adjust. Today, those loans are about 10% of all mortgages outstanding. Back then, in 2008, that percentage was more than 35%. Credit standards, lending standards rose sharply. Those were lessons learned from the global financial crisis. So look at how disciplined underwriting and lending is. Bottom left, we're talking about mortgage origination by credit score, and those blue bars are mortgages that are in the hands of people that have credit scores of more than 760. So the borrower is far more credit worthy. And finally, household debt to income ratios have declined significantly. We are actually at all-time lows. Mortgage debt is only 43% of the value of homes home prices have gone up so much that the cushion above the minimum 20% equity requirement gives you tappable equity credit through home equity lines of credit of 11 trillion. The housing market is in good shape.
Okay.
Not to worry.
That's good news. So, Sandip, how does this all add up? What's your overall outlook for the economy, for the markets? Are we for sure going into a recession? How long is this bear market going to last? And of course, I know if you had exact answers to all of this, we'd both be rich. But what?
And I suspect neither of us might be actually doing the webinars.
Yeah, exactly. But given your experience, what's your best guess?
Okay. Look, the consensus view is that a recession is all but a foregone conclusion. And that may yet come to pass because the economy is strong enough to produce a fairly high level of nominal output. Mm-hmm. But when we talk of economic growth, we typically subtract inflation. So we never talk of nominal growth. We talk of something called real economic growth, real GDP growth. And so that is what has led to concerns about the recession. But the underlying fundamentals, the US consumer is still strong, incomes are intact, jobs are aplenty. You have 11 million job openings. In the 6 months of this year, we would have added more than 2.5 million jobs. Those don't give you the backdrop for a traditional recession. So nominal growth is still projected to be high in 2022. What is an absolutely remarkable outcome of the first 6 months, and by the way, there are some people who feel that with a negative first quarter for economic growth declined by minus 1.4% on a real basis, and growth is flirting with negative territory in the second quarter, that we may already be in one. I just want to point out that earnings, at the end of the day, stock prices are influenced by what is happening with profits and earnings. And here, earnings estimates through the first half of this year have continued to go up. We show numbers for 2022, for 23, for 24. I circled the number. I don't know if the number is visible on your screen or readable. 2023 earnings are expected to be $250 for the S&P 500. It's remarkable that we haven't seen a dent or a decline in that number. The big question, David, of what lies ahead, and if we get a recession of the shallow and short variety, what would be the extent of the bear market? It all comes down to what happens to earnings for next year. If they hold steady here, they would hold steady if we somehow manage to skirt and avoid the recession. If they decline by 10%, that has a different implication for what multiple you can put on those earnings and where that would leave the stock market. If they decline substantially, that suggests that the bear market has longer to go. So without belaboring the point, if you see no decline in earnings, the S&P 500 could easily be up 10% from here over the next 12 years. You would derive this by applying a multiple of 17 times to an earnings level of 250. If you get the 10% decline, that's an S&P 500 level at a slightly lower multiple of 3,600. I know our viewers might be more familiar with the Dow index, but the S&P 500 is trading at 3,800. And should earnings crater, decline by 20%, go all the way down to 200, you would have a yet lower multiple of, say, 15 times. That's a price level of 3,000. So how do I summarize this all? The further downside from here could be anywhere from 5, more realistically to about 15%. We may avoid it if earnings hold up and the recession doesn't come to pass. However, on the other side, for tolerating this decline and working through it and being patient and staying the course and not despairing or not panicking, on the other side would lie another bull market, which historically has produced equity returns of 8 or 10%. And so I'm going to suggest to our listeners that the bulk of the sell-off could well be behind us. Again, best judgment. Can't pinpoint the recession. We may yet get a technical one. It may be shallow. It could be short. But we don't think that we are looking at a protracted bear market. And because interest rates have gone up, David, I keep getting asked a question of, are now bonds more attractive than stocks? And ever so quickly, I'm going to say that the blue line shows the earnings yield on stocks. This is for $1 of price. How many cents of earnings could I get? What's my percentage earnings yield? The green line is the 10-year bond yield. Earnings yield for stocks is higher than that of bonds. And that generally has suggested that stocks are more attractive.
Okay. Well, we only have probably about 8 minutes left, but our audience is composed of family businesses, and they not only have their businesses to worry about, but also their personal wealth. What kind of advice do you have for them in this environment? Is it a hold tight? What would you advise?
So I'm going to take a shot at this at two different levels. So let me talk about your businesses first, right? And I'm going to break out some suggestions here along 2 dimensions. First, how do you protect your top line? How do you protect revenues? And then what can be done about the bottom line? So the top line first. Stocks, corporations have a very useful attribute or property, David, that in the early stages of rising inflation, they are able to pass inflation through. That's a way through which they can protect margins. Their input cost goes up, but if they can pass the price increase through, they can protect their margins. So I would urge our business owners to see if they could judiciously, prudently, and selectively exert pricing power in their business as quickly, as nimbly, and as urgently as possible. Number 2, consumer preferences are shifting. Before the pandemic, they were preferring experiences over goods. That changed during the pandemic. It was the goods. It was the Peloton bike. There were no experiences to that. You couldn't go anywhere. And now the pendulum is swinging the other way. So keep this at the back of your mind. Another shift in the consumer mindset is, they're focusing on defensive must-have items instead of discretionary nice-to-have items. So adjust your mix of products, your inventory stocking to cater to this dynamic, and perhaps you can protect your top line. In terms of the bottom line, we talked about supply chains. They're not going to get fixed anytime soon, especially if you're dependent on global supply chains. Factor that into your inventory management, reshore, line up alternatives as much as possible. In terms of costs, by all means, cut out anything frivolous, but do not compromise on key strategic initiatives. The value of a lifetime newly acquired client can be significant. And as your competition gets weaker, go ahead and acquire, make strategic investments, this time at the expense of narrower margins, so that you come out stronger on the other side. In terms of the investment portfolio, a lot of damage has been done in the capital markets. So at this point, it is simply too late to panic. And again, you would be doing it to protect what we believe is a further 5 to 15% downside against the prospect that in a new bull market that lasts for another 5, 6, or 7 years, the gains through that entire cycle could be 40, 50, or 60%.
Right. Indeed. Interesting. So here we are, 4 minutes. Can we go to some summary and key takeaways from you? What are the big takeaways that our audience should have?
So in the interest of time, oops.
Whoop. Got it.
Okay. We both hit the clicker at the same time.
Yeah, we did. Sorry.
Yeah, we flew through 3 slides with 2 keystrokes. So just quick takeaways. Inflation is by far the biggest economic and market risk. Everything that I said to hold out hope that this may not have the worst possible ending is predicated on inflation organically and naturally rolling over if it doesn't come to pass. If we are still at 8% headline CPI inflation 12 months from now, God help us all, there'll be a lot more carnage. And maybe we'll give you a different piece of advice. Inflation may peak soon. I think it has plateaued. That's a fair observation. On the other side of the peak, the descent, let me warn you, won't be nearly as quick and rapid as the spike was. It will come down, but more gradually. So if target is 2%, you ain't seeing target in 22 or 23. Core inflation may come down to 4% at the end of this year, maybe 3, maybe 2.5. 2 is still a distance away. The Fed alone cannot lower inflation by itself all the way back to target. It needs help from the private sector, so watch out for what's happening with global supply chains. They're doing the right thing in managing inflation expectations. And the best news, as an offset to all of the headwinds that we spoke about, is that we have a still strong labor market. If unemployment goes up, it'll go up to 4.5%, which by historical standards is a really healthy labor market. And the US consumer has a clean, pristine, healthy balance sheet. Incomes are high. Consumer net worth is close to an all-time high. And that supports the US economy.
Well, and if you've been on an airplane recently, they are packed. So people, not only is it a strong labor market, the U.S. consumer continues to spend money on those experiences that you were talking about.
Correct. And there was a pile of excess savings, right? When they got the stimulus checks but had no way to spend them, by most count, that is 2.5 trillion. And that's allowing them to absorb the higher prices and continue to spend. Again, won't last forever, but we need to get this timing right, that if it can tide them over to such point when inflation rolls off on its own in 3, 4, 5, 6 months, maybe we avoid the worst case. So I couldn't be more positive or optimistic, and I hope the audience found this to be somewhat useful. I think we covered a lot of ground, and David, again, I want to thank you for having me.
Well, I'd like to thank you as well. It's the kind of thing that makes me feel a bit better that a chief investment officer for a major trust company would be not necessarily bullish, but not bearish, right? And that's kind of a key in this moment, is managing our expectations as well.
Right.
Indeed. Well, thank you so much for what has been a really terrific session, Sandip. I'd like to, if you'd like to explore this kind of thinking even further, please join us for our Legacy and Wealth Conference this September at the JW Marriott in Chicago. We'll be talking about the economy and where we stand, and hopefully seeing some better news by that point. But with that, I'd just like to wish all of you a wonderful summertime. I thank you deeply for being part of our webinars, and I hope you'll join us for the next one. Thank you very much.